Hey guys, how's it going? So today we are going to go over one of my favorite books of all time. I absolutely love this book, and it is super valuable for improving your crypto investing. Even though it was written in 1932, doesn't matter, it was super valuable. And I've wrote a thread on this, but I figured why not make a video to go over it, because I can cover a lot more depth and I can really teach you guys in a more extended manner on the key lessons inside of this book. So yeah, 1932, Reminiscences of a Stock Operator. It's basically a book about this guy's experience trading stocks for a living, all the money he's made, all the money he's lost, the main lessons that he's taken away from the market. And he's put it all into a pretty simple, easy to read book, which is so fucking interesting. And yeah, I've got a few key lessons here and I wanted to go over them. So the first one, he basically talks about when people enter trades, they often have dreams and desires of the profit that they're going to make from this position, right? You enter a trade and you're like, man, if this or even an investment, right? You enter a coin, let's say, put $10,000 in and you start doing the maths. Oh, if this just goes up 20x, it's going to be a $200,000 position and I can sell it and I can buy that car I've always wanted. This approach never works in crypto, in stocks, in any market. You cannot place your dreams and desires on this potential growth of your crypto portfolio. Because if you start placing arbitrary levels where you'll do this or you'll do that, you're placing an arbitrary goal of what you expect price to do, and it's going to bias you in when you're going to make decisions on what you should be doing with the position. So if you expect price to 20x because a $200,000 position can buy you a $200,000 Lambo, right? You're now going to only sell if price gets to $200,000, which is retarded. It is stupid. You can't place your expectations onto what the market is doing. You have to flow with the market. And so if we read it, what it says is that, like all well-authenticated hoodos, I don't know what that means, that it has its reason for being. What does a man do when he sets out to make the stock market pay for a sudden need? Why, he merely hopes, he gambles. He therefore runs much greater risk than he would if he were speculating intelligently, in accordance with opinions or beliefs logically arrived at after a dispassionate study of underlying conditions. To begin with, he is after an immediate profit. He cannot afford to wait. So this really talks about when people have said this, they've come to me and they've gone, hey, Daniel, I've got this big bill coming up soon. Do you think I can just trade crypto and turn my $1,000 into $2,000 and, I can pay off that bill that I've got for my mother? I'm just sitting there like, that is never going to fucking work. You cannot force the market to give you something that you want it to give you. If you could force the market to double your money to pay for your mother's medical bill, you could force the market to do it 100 times and you'd be a billionaire next week. But unfortunately, markets do not work like that. The market will not give you what you want. It will give you what you deserve. And that's why we talk here about speculating intelligently. Speculating intelligently is the market giving you what you deserve. Being intelligent is how you make money. And so the second part is interesting. There is nothing new in Wall Street. There never will be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and it's going to happen again. So this is why when people say you need to have a full market cycle before you truly understand markets, it's basically because of this, right? If you have seen the bull market, the bear market, the accumulation, and the new bull market, you have seen every single potential part of the market, right? And the thing is with stocks, because stocks have a really, really long and extended market cycle, right? You have a 10-year bull run and then you have a 2-year bear market, right? Whereas crypto, you have a bull and a bear market encapsulated in about 4 years roughly, right? So in stocks, it might take you 10 years to see the entire market cycle. But in crypto, you can have the full fucking experience in 4 years, which is so much better, right? You're getting like a speed run of the entire market cycle, which allows you to learn faster, right? It's more volatile. And so until you've seen a full market cycle, you haven't seen every single dynamic that can happen in a market, right? If you have never seen the end of a bull run, how would you know what an end of a bull run looks like? But the thing is, once you've seen the end of a bull run, you can use that skill for the rest of your life. You will always know for the rest of your life what a market top will look like. You'll never forget, because they all look the fucking same. They're just different, right? Back in 2018, the top was marked by these influencers entering the crypto space, right? Everyone talking about Bitcoin, making like ads about Bitcoin. Every person and their fucking grandma was talking about it. Now that happens at the top of every single market top, right? All the retail start getting involved and everyone's talking about the market, all the profits they can make. That happens at every top. So all you need to do is spot that same pattern and you can sell the crypto top every single 4 fucking years, right? And obviously you have to be able to act upon the insight. Just because you see it's a top doesn't mean you'll act on it being a top, but at least it's the first step, right? It's the first step is awareness. And that's why this is interesting, right? That's why this book is applicable. 1932. How is a book written 80 years ago applicable today? Well, it's because all the lessons from this book keep occurring into perpetuity. This book will be relevant for markets in the year 20,536. As long as humans' emotions and greed and fear and biases, cognitive biases, as long as they're all still in play, it'll still be relevant. And so what's the next section? Don't buy the laggard in a group hoping that it will catch up. Yeah, so this is what Peter, one of the oldest investors, he's basically a grandpa on crypto, talks about a lot. He's been investing for 45 years. You want to long or buy the strongest member of a category, and you want to short the weakest category. You want a long strength and short weakness. And this is a concept that has been around for ages. And there's no photo here, but I think there's a quote. Experience had taught me to be aware of buying a stock that refuses to follow the group leader. So yeah, if you have, let's say the leader, let's say it's Ethereum, right? It's the layer 1 protocols, Ethereum. And let's say you have an L1 like AVAX, and AVAX just is not fucking moving. It's going down, it's slow. When Ethereum went up 10%, AVAX went down. You do not want to buy AVAX because it's low. You want to buy Ethereum because it's going high. You want its momentum, right? Something that goes up tends to continue to go up, and something that goes down tends to continue to go down. And think about it, right? If AVAX is going down while Ethereum is going up, that shows that there's something wrong with AVAX that you should stay away from it for. Because for some reason, there's people selling a ton of AVAX who are super bearish on it. And that's what he's saying here. Same lesson applies. And so the next lesson, the big money in booms is always made first by the public on paper, and it remains on paper. This lesson is so fucking important. Let's go over it. Let's look at the Bitcoin chart. So Bitcoin, right? If you look at this chart, where do you think retail starts buying crypto? If you look at this chart, retail starts buying crypto over here. This is retail. This is the retail part of the market. And so retail joins here, right? They join here, retracement, rally, everyone's making money. You know, the big money in booms is always made first by the public on paper. So all the people who are first-time investors, newbies, getting into crypto, they're all making money. Everyone's getting rich. We're getting rich together. But that's it's short-lived. And as it says here, the money is made on paper and it remains on paper. So yeah, retail makes 5x on some shitcoin gambling, thinking they're some fucking genius, but they don't keep the profits. They don't keep them. That's the biggest problem. So if you're an intelligent investor, you need to understand that profit taking is the only way that you'll be able to keep bull run profits. You can't expect to join in a bear market, buy, ride the bull market, never sell, and expect to keep your money. It does not fucking work like that. If you make money in the bull run, you have to take profits, because if you don't, some other smart person will, and you're going to be left holding the bag like all these retail people who join at this part of the market cycle, which is too late. See, if you bought down here, you're still in a profit on Bitcoin, right? But if you don't take profit when retail joins, at least towards the end, then the opportunity cost of, not even opportunity cost, but just the portfolio loss you're going to experience is not good. So yeah, remember that. Retail makes the money first, and then it stays on paper. They don't actually keep it. This is an interesting section. So this section, there's a trader called Old Turkey that the guy who wrote this book was talking to. And he talks about the approach Old Turkey takes to riding positions in the stock market. And basically what he says is, when you are as old as I am and you've been through as many booms and panics as I have, you'll know that to lose your position is something nobody can afford. Not even John D. Rockefeller. I don't know what that is. I hope the stock reacts and that you'll be able to repurchase your line at a substantial concession, sir. But I myself can only trade in accordance with the experience of many years. I paid a high price for it, and I don't feel like throwing away a second tuition fee. But I am as obliged to you as if I had money in the bank. It's a bull market, you know. This is basically saying that in bull markets, you do not want to lose your position. Now, what I just said about selling, I just told you that you need to sell, and now I'm telling you that you need to not sell. There's nuance here, right? If you see prices rallying here, right? You see the price rallying, and you're thinking, like they're talking about here, oh, well, the price has risen. I'm going to take profits so I can buy lower. Well, look what happened here. You take profits to buy lower, and the fucking chart never slows down. It never stops. That is what happens at the beginning of a bull run. And what happens in every single bull run is you are always going to underestimate how long the bull run is going to go on for. Every single time this happens. And I speak from experience of being through 2 separate bull runs. If you can call this a bull run, I would call this a bull run, almost like a mini bull run. And so what happened was we got to around this level here, and I just thought to myself, like, there's no way this is going higher. We got 6K resistance, right? Look at this resistance here. 6K resistance. You look at that and you go, yeah, that's a big resistance level. All right, I'm going to take profits at 6K and I'm going to rebuy lower because there's no way it's going to break through. And then you know what fucking happens? It goes straight through and then it continues all the way up from 6K to 14K. So this is what this guy is talking about. He's basically saying, look, I know that you can take profits and you can maybe buy lower, but I have learned from my many years in stocks that if you sell to buy lower, you will miss out on this rally that is going to occur. That's what he's saying here, and that's what's happening here. Same thing happens over here. You take profits at the beginning of a bull run, you're going to be left behind. And so what Old Turkey was actually also referring to is that the big money is not just made in individual fluctuations, but in the main movement. See, when you do crypto, if you're an investor, you do not get rich buying a coin at $1, selling it at $1.10, buying it at $1.5, selling it at $1.20. No. When you are in the bull run and everything's popping off, all these coins are pumping, you're going to want to buy and sell and flip and sell the slow coin and buy the pumping coin. You're going to want to go in all different projects, right? That is not how you make the big money. The big money is from 1 or 2 big investments that you make that you ride for the majority of their movement, right? You capture 80% of the move. Maybe you don't enter at the bottom. Maybe you don't sell at the top, but you're capturing the bulk of the move. You're getting 80% of a 50x. That is where the big money is made. And trust me, this is me speaking from experience. When I was beginning my crypto journey and all these altcoins are popping off, back in one of the alt seasons that we had, I kept making this mistake. And I didn't learn for a while, but I kept making this mistake. It was, you see a coin pumping, and you're currently holding a coin, right? And there's some other coin, and it just went up 50%, and your coin didn't move. And so what you do is you sell the coin you have now for the other coin, because it's pumping, and you want to, make money. And then a week later, the coin that you bought is down, and the coin that you sold is up. And you're like, fuck, I should have just waited. And so then you go and you buy back the old coin, thinking that it's going to keep going up, and then that one goes down. And then you see another coin, and it's just endless cycle of constantly trying to chase small moves, when if you just focused on the one big main movement, you would make the big money. If we read this again, he really meant to tell them that the big money was not in the individual fluctuations, but in the main movement. That is, not in reading the tape, but in sizing up the entire market and its trend. So yeah, reading the tape is basically like trying to trade the chart, trying to be a trader when you're not one, So reading the tape, trying to trade instead of sizing up the entire market and its trends, so investing, right? And so the next lesson is, in a bull market, the game is to buy and hold until you believe the bull market is near its end. To do this, you must study general conditions and not tips or special factors affecting individual stocks. Then get out of all of your stocks, get out for keeps. Wait until you see, or if you prefer, until you think you see the turn of the market, the beginning of a reversal of general conditions. You have to use your brains and your vision to do this. Otherwise, my advice would be as idiotic as to tell you to buy cheap and sell dear. So yeah, basically what it's saying is that you want to ride the majority of a bull run, You don't want to capture the exact bottom or try to get out at the exact top. You want to capture the majority of it. Buy, hold until you believe the bull market is near the end. The key word of this is near the end. Doesn't matter if it's at the end, as long as it is near the end. And then once you get out of the position, once you get out of the market, do not buy fucking back in, because look at this. I'll show you a classic example. If you look at this chart and you go, okay, look, Daniel's theory says we're near the top, and let's pretend that we're in the current, let's pretend that we're back in crazy COVID bull run when everyone's locked in their house. Let's say you look at this and you go, okay, this is near the top. Look, we're up 6x on Bitcoin. It's a huge market cap. We're near the top. Retail's back in. I'm going to sell. And then you sell, and then you go, okay, look, the market's down a bit. Okay, okay, I'm going to, let's say like right here you go, okay, the market's down a little bit. Okay, maybe it's time to buy back in. And then you decide to buy back in right here, right? And then the price keeps crashing lower and lower and lower. See, the idea is not you're exiting to enter back in a month later. The idea is that you exit and you stay exited until you see a general reversal, the reversal of general conditions, okay? That is the really important part. You don't just exit and then put it all back in a month later, because this is what people go wrong with. See, even over here in the recent bear market, a lot of people will exit the market thinking they've taken profits, and they will be impatient to get their new entries. They'll start buying back the coins they sold because they're at a 20% discount. No, you have to be patient. You have to be willing to hold cash for 6 or more months after you've sold at the end of a bull run, or you're going to get fucking caught buying a bag when it's still too high. And so we'll do one more section of, there's so many that I've covered here, but we'll just do one more. This actually sums up what we've talked about really well. One of the most helpful things that anybody can learn is to give up trying to catch the last eighth or the first. These two are the most expensive eighths in the world. They have cost stock traders in the aggregate enough millions of dollars to build a concrete highway across the continent. So this is so important. What this guy is basically trying to say is that, let's say this is the bull run, right? Let's delete this shit. Delete this mess. Let's say that from here, let me try to draw this. Let's say that from here to here, this is the bull run, right? You are not trying to snipe the exact bottom. You're not trying to snipe this. You're not trying to snipe the exact top either. You're not trying to, oh, I'm going to get the exact bottom entry. Oh my God, I'm so good. You're not trying to get out at the exact top, okay? You are trying to have a system to recognize, okay, we're near the bottom. Let's start buying. And then you buy, and then you hold, and then you go, okay, we're getting near the top. So you want to capture 80% of the move. So capturing 80% of the move is going to look like this, right? So if you try to play hero buying the exact bottom, what it's going to look like is you buying here, buying here, buying here, buying here. Price goes 50% down in a week, and then you're going to sell the bottom. What you need to do is recognize, okay, look, we're near the bottom. I can see that the bull market is coming back. The Fed just turned on the printer, etc., and you buy to capture the majority of a move, the majority of a bull run. So anywhere in this area here where you determine that it's the beginning of a bull run, you can buy. And then you need to exit whenever you think we're near the end of a bull run. So you only need to capture 80% of the move, right? So this is the 80%. The green is the 80%. That's what you want to capture. You don't want to try to capture red, because if you capture red, or if you try to capture red is what I mean, you will fail to capture green and you won't get anything. And so that's all the lessons that we'll cover in this video. I don't want it to go on for too long, but as you can see, there is a lot more lessons in here. If you want another video of me ranting, talking about the takeaways from this book, I'd love to make one. If you're interested, I will. So leave a comment below if you want to see more of these, and I'll see you in the next video.